Hi, it's Lon Welsh at Ironton Capital. Where are you joining us from? It's great that we can invest from almost anywhere these days, isn't it? How many of you would like to get more diversified within your portfolio or your self-directed IRA with more passive, diversified real estate investments? How many of you would like to get off the 1031 exchange treadmill and go from active to passive real estate investing while managing your capital gains exposure? And how many of you would like to have a targeted IRR, internal rate of return, of 16 to 20% a year on a 4 to 6 year long term? Well, that's what I've been hearing from a lot of you that you want, and that is exactly what we have today. We're going to show you some actual case studies and hard data today, but none of it is to be interpreted as a claim of income, implied or otherwise. So a quick letter from our attorney. There's a lot of confidential information in today's presentation. Investing in a fund involves a high degree of risk, so you'll want your financial team and advisors to look over what you're considering. There's no offering of investment opportunity in today's discussion. If you find this interesting, we would be pleased to share all of the formal investing documents for your financial team to review in depth. There's a lot of forward-looking statements. You're going to hear things like may, should, will, expect, plan, seek, anticipate, and that's based on information from the sponsors that we're working with, our analysis of the market, and our analysis of what we've gotten from the sponsors. You and your financial team will want to do your own due diligence and analysis, of course. And finally, there's a lot of company sourced information in today's presentation, so you'll want to do your own research as well. In short, your results are up to you, and I can't predict them. So here's the team at Ironton. There's 3 of us on the investment committee. I worked as a strategy consultant for 8 years at Deloitte and Accenture. I've been doing commercial real estate full-time for a little over 20 years. I've got an average of over 20% internal rate of return over the lifetime of my investments. I created and grew a very large brokerage, Your Castle Real Estate, to be the largest independent in Colorado, 750 agents. So I got to see lots and lots of investor transactions there, as well as the ones I did myself. Brent Geyer, he's our CEO, 25 years of real estate, land, acquisition, development experience. Before that, he was a CPA at KPMG. And Richard Landry comes to us via Goldman Sachs and used to run as the chief investment officer a $2 billion family office. So the 3 of us are full-time in reviewing potential investments for you. So passive investing really equals freedom. If you could put your investments on autopilot, then you're on your way to where you want to be with true freedom, especially if you can do it in a reasonably short amount of time. And I believe that is what we all want, freedom to experience life to the fullest while we're still healthy enough to be able to enjoy it. And ultimately, that's what this training is all about. So consider for a moment how good you'll feel when you can stop trading hours for dollars and actually enjoy your travel, hobbies, and charity work. So our ultimate mission today is to help you do that quickly and consistently. What are the challenges? Well, there's a lot of information out there. It's hard to sort through. It's hard to find the lucrative patterns. We want to add more investments to our portfolios, but there's just so many assets that we can manage at any one time and give them the time and attention that they all really deserve. We think about our portfolios in that they have to be bigger before we can participate in what we think of as commercial grade or institutional grade investments. So you've educated yourself probably as much as you can. You've acquired a lot of assets, and they're eating up more and more of your free time on the weekends until it feels like you almost have another full-time job. And you would like to retire, but it's getting harder because of all these distractions. Wouldn't it be great if there was a simple, proven system to solve this for you? So we've got 4 types of investments. We've got a long-term fund that's all growth-oriented. We have a short-term and a medium-term income fund, so no growth, just all income, and occasionally we'll have single asset funds. And depending on your needs, we can help you mix and match these to get what you need to accomplish. Working with experts makes investing easier. Most people start their real estate journey as a project sponsor. They select and manage the project, they find the funding, they manage the property, the financials, they guarantee the loan. And this is also where most people stop because they get burned out on the constant 1031 exchange treadmill with one project after another. We've all been there, right? I certainly have been personally, and I've watched thousands, literally, of investors through the brokerage go through this journey. A lucky few become limited partners where they just pick the investment and sit back and deposit the returns. And that's made possible by the general partners like Ironton, who step in the gap to do all the heavy lifting, monitor the markets for the best opportunities, network to find the best sponsors, and perform exhaustive due diligence, negotiate the deals for limited partners, and then take care of the accounting and paperwork and the reporting. So what we do on your behalf as a general partner, you are the limited partner, so you can have a more relaxed lifestyle. So these are our standard practices when we work with accredited investors to make their life a little bit easier. So standard practices, we work with people who are accredited. Many of these are what we think of as entry level, high net worth, 1 to 5 million, where they're underserved by traditional wealth management and they don't have access to institutional grade investments. Our job is to solve that for you, primarily in the real estate space. So we get to work with a couple of outside accountants to do our tax returns, and we do get an outside audit on one of our funds, the medium-term income fund. Here's the track record for our long-term growth funds, and you can see most of them are in the low teens. The fund that we're going to talk about today is also performing very well. So for Fund 11, what is it we're anticipating? We're hoping to be in the 16 to 20% IRR, internal rate of return. The term should be about 4 to 6 years. Of all the investments that we make in this fund, we may have 1 or 2 that'll go just a year longer. Hopefully not, but we do have the option to do that if we have to. There's no liquidity, and there is, if you need it, the option for a share class with accelerated depreciation, which you can use to offset your capital gains if you're selling an active real estate rental. So all of our long-term funds benefit from the 4 pillars of diversification, which is 4 important ways to manage risk. Our main priority is the preservation of your and mine, because I invest with you, investment capital and maximizing returns. So what are the pillars of diversification? Well, the first is geography. We want to have multiple investments in key markets. We cover most of the better real estate markets in the country that have high population and high employment growth, giving us a lot of geographic diversity. We want to be in about 10 states if possible. The second is asset class. So we'll be in multifamily, residential, and industrial primarily. We may have 1 or 2 other things like hospitality in the long-term stay sector, for example. From a strategy standpoint, we diversify across both value-add projects and new construction. We do not do buy and hold. If you want a lower return, lower risk investment, real estate investment trust, those tend to focus on long-term buy and holds. Those are a really great option for you. And if you need guidance, call me up and I'll talk to you for a couple minutes about that. And then from a sponsor standpoint, we like to work with multiple sponsors because they all have their strengths and weaknesses. We'll probably have at least 6 sponsors in Fund 11 and at least 35 buildings. So that's how we like to diversify and manage the risk. Just like if you buy a stock fund with 100 or 500 stocks in it. Here's a sample of where we anticipate a lot of the projects will be, pretty well diversified across the country. This is a quick summary of the 6 investments that we've identified so far for Fund 11. I'm going to talk about each of these investments in detail on the next couple slides. An important thing for you to note is that this is not a blind fund. When we finish raising the capital and we finish identifying all the actual investments, we will do a briefing just like this one for you, and you're welcome to bring along your financial advisors. We'll review the actual finalized investments, why we're excited about each project, the risk factors that we see, and the mitigation steps to offset that risk. And we'll give you a written report that summarizes that. And then you and your financial team will have 10 days to review it. If you don't like it, you can tell us, I don't want to be involved. We'll give you your money back. You're going to be stuck with this. There's no liquidity. So you're stuck with me for 5 years. I want you to be just as excited as I am about every project. At the moment, with the projects we've identified, we're tracking to about an 18% internal rate of return, which is just about in the middle of our targeted 16 to 20% annual return. So let's meet the investments. Oh, first, I guess let's talk about the cash flow timing. So you'd make your investment this year, and you'd probably get most of your capital back in 2030 and most of the profits in 2031. If you invest $100,000, we anticipate you'd get $100,000 back and approximately $96,000 of profits on top of it. Of course, there's no guarantees. This is just our best estimate of the data that we have available right now. So the first sponsor I want to talk about is Hill Point. This will probably be our largest investment within this fund, and it's a sponsor that we've worked with multiple times in the past. They're based in the southeastern U.S. They build what's called workforce housing. So workforce housing is in the middle of the market, so it's not Section 8, it's not government assistance, and on the other hand, it's not luxury either. It's new construction without a lot of bells and whistles, just basic for middle market Americans, firefighters, school teachers, police officers. What we do is there's one standardized 2-bedroom, 2-bath apartment complex. And there's just this one unit type. And the buildings are either 12, 24, or 36 of these identical Lego blocks of 2-bedroom apartments. And then the overall community might have 10 to 15 buildings to come up with a community of, say, 200 to 300 different units. And there'll be a clubhouse with a gym and a pool in the middle of it. Every single building is the same. Every single unit is the same. And our goal is we'll build about 20 to 25 of these large communities across the entire fund. So just our one investment in Hill Point gets us access to 20 different locations. What we love about this is that everything is standardized. So they can go to China or Vietnam or Malaysia and they buy one package of kitchen cabinets, and it's the exact same configuration for every single unit they're going to build for this fund. Same for the templates for the countertops and the faucets, the sinks, the appliances, light fixtures, the LVT, luxury vinyl tile, floors, all of it is highly standardized. So the other thing that's great about this is that they use the same crews over and over again. If you've been a developer and built from scratch, you know that when the architect releases the final plans, the general contractor's out in the field trying to build, there's always mistakes in the plans or things that are ambiguous, and you've got 16 guys on a paid crew sitting there twiddling their thumbs while the engineer, the architect, and the general contractor try to figure out how to solve a problem. And it's amazing how much waste takes place on a job site when you're building a one-time only construction project. If you have the same crews and the exact same plans over and over again, it gets extremely efficient. And this collective set of gains enables these units to be built for about $50,000 to $60,000 less per door than a comparable new build of a custom project. And that's why we're able to be so profitable. So our target is to generate about a 22% annualized rate of return. That's pretty consistent with what they've done for us in the past in earlier funds. Definitely one of our favorite sponsors by far. And you can see that at this moment, we've got 6 properties that are already under construction. One is in pre-construction status, and there's a robust pipeline of more than 43 potential projects. So we'll probably pick about 16 more that'll go into this particular fund. And there's a little bit of detail. The first of these will be delivered in around summer of 2026, one of them in spring of 2026. So making excellent progress on Hill Point. The next investment is called PFD, and this we are a co-GP with PFD for our medium-term income fund. So this is medical receivables. The reason why we put some of our money in this is the people at Hill Point will make a commitment for, let's say, I'll just make the math really easy, $1 million. It'll actually be a little bit more than that. And what they may draw from us each quarter is about $100,000. Not exact numbers, but just to make the math easy to follow. And what they'll do each quarter is they'll launch 2 or 3 new construction projects each quarter, and our $100,000 contribution plus everybody else's is how they fund that. They don't take the entire $1 million up front. So when you close with us, you'll send us your entire commitment, and whatever money is not required for PFD, I'll put it at, I'm sorry, not required for Hill Point, I'll put with PFD, and it'll be returning around 12% or so. So it's earning a good return while we're waiting to disperse it out to the projects. We'll also raise a little bit more money than we actually need to keep in reserve. So if there's a small capital call from one of our other projects, this is how we can fund it without having to go to you to ask you to write a check for a capital call. PFD, if you're an investor in the medium-term income fund, you already know, invests in medical receivables. So if you have 2 people involved in a car accident, someone is injured, they've got a relatively small claim, let's say $35,000 is their medical bill, it's not worth it for the physician or the clinic to do all the paperwork to get the claim paid by the insurance company. So we buy the claim, we take over the paperwork process, and the doctor gets the money today so they can maintain the cash flow of their operation. We typically pay about 35%. So if it's a $35,000 claim, we might give them $10,000 or $12,000. We like to have a basket of about 100 of these claims. We'll advance on about 95, 97 of them, and they're all cross-collateralized. We expect a few of the claims will be eventually shown to be fraudulent and we won't get paid by the insurance company. No problem. Since they're cross-collateralized, any one of them that fails, we can go after the other 99 to get paid. So nothing is bulletproof, nothing is foolproof, but this is pretty good. So very high degree of risk diversification with the the cash that we have to hold in the fund. Waverly on the Lake. This is our third project. So this is about 1,000-unit multifamily on a lake in Michigan, just outside of Ann Arbor, which is where the University of Michigan is at. You can see from the overhead photos, it's a beautiful project. The prior owners didn't take very good care of it. So if you look in the upper left, you can see we've got these cabinets that are old looking with old appliances. So our goal is to renovate a lot of the units and do a large increase in the rents. We've also got a grant from the utility company locally to replace the inefficient heating and air conditioning systems with high efficiency systems that will greatly reduce the electric bills. So over a 4 to 6 year period, we anticipate this is going to generate about a 16% annualized return. Thanks to the new tax bill that passed in July, bonus accelerated depreciation is now back. We anticipate this particular project is going to generate a lot of depreciation. So for those of you who are selling an investment property and you've got a capital gain, we'll be able to offer depreciation to you to offset your gain, and this is one of the main projects that's going to deliver that to us. What's exciting is we're a little bit ahead of schedule. The first 10 renovations have already been completed. 3 of them have been leased at or above the pro forma rents. So we've gone from about $1,025 in rent to just under $1,400 in rent, so about $375 rent increase after the renovation. So pretty great project. We bought this as is with the rents in place on an 8.7% cap rate, about $80,000 a door, and we think we're going to sell it for about double that. So very exciting project. Okay, RPM Living is multifamily, and they will probably generate about a 17% return. They're either going to do new construction or value add projects depending on the types of projects that they acquire and allocate. So here's some pictures of some of the units they've done in the past. You can see these are high-end luxury, very nice. There's about a dozen projects that will be in this RPM portfolio. So Hill Point, the first thing I talked about, will be 20 to 25 different locations in probably 5 or 6 states. RPM will be another dozen buildings scattered across 3 or 4 different states, Texas, Georgia, Florida primarily. But you can look at the details on here and see that a few of these were acquired in 2023, some in 2025, and some are new construction, some are renovation, but you've got all the details here if you want to review that in depth. Very experienced operator. They've acquired and managed over 40,000 units, and they've gone full investment cycle on more than 100 projects. So we're very happy to get a chance to work with such an experienced sponsor. Eagle 35. So this is a new industrial project. Our sponsor on this is a group called Provident. They're one of my favorite sponsors. I invested with them in a couple projects in Fund 1 that were very successful, actually our most successful individual projects that we've had so far. This particular project, they first released it, as they typically do, just to friends and family that have invested with them in the past. I got it on a Saturday morning, and I emailed them back a couple hours later saying, I'm in, give me at least $250,000. I think I want to do $500,000, but I need permission from the investment committee. I can get that to you first thing on Monday morning. By Sunday afternoon, this thing was sold out just to the existing investors. It never was seen by anybody else. So we are building a new warehouse in Austin, Texas, and it is a configuration of warehouse that is in short supply in this area. So we anticipate it's going to be a pretty high return. Just for your education on Provident, what is their expertise with warehouse, you might ask? Well, they've built over, just short of $6 billion of real estate projects in development over their lifetime. They're currently managing just short of $3 billion of those, and they've built over just under 15 million square feet of industrial. So this new project is just yet one more project for them. Lots and lots of deep experience here. Mariposa. So this is actually the one that we've got that's in Colorado. I wish that we had more that were like this. So for those of you who are familiar with the Denver metro area, this is the north, this kind of central part of the city itself. So we're actually in Denver in a nice central location. Hopefully this will be a 2 to 2.5 year long project, about a 17% return, and we're going to be building a couple of new duplexes. And I think I don't have a rendering for this one yet. So it'll be 4 units in total, and we're anticipating about a 17% return. The sponsor on this has about 50 years of combined experience, 200 remodels, 100 new builds. and their current active portfolio is a little bit over 25 million. So great little boutique shop, and very excited to be part of this. We'll probably be able to do some tours of this project for you guys if you'd like to come out and see them at some point. So let's recap. Our target net return at the moment is 18%. We'll probably add a couple more investments to this, so it might go up or down a little bit. Anticipating a 4 to 6 year life. The RPM projects in particular are the ones I think that might take an extra year or two, but most of these will liquidate before that. The preferred return paid to you as a limited partner. So if you're in the A class, you get a slightly higher preferred return of 8%, and you get none of the depreciation loss. The B class gets a slightly lower preferred return of 5%, but it takes all of the depreciation write-offs. So if you're currently an active investor selling a rental property and you don't want to do a 1031, the B class shares will be able to allocate a lot of depreciation to you to offset your capital gains. But if you're investing in an IRA, for example, the A class with the higher preferred return is definitely the way to go for you. How does carried interest work? Well, the first thing that happens is all the preferred is paid up. So in the first 2 or 3 years, there probably won't be any cash flow. So we will stack that up for you. And all of the backlog of preferred has to be paid before we start getting any bonuses from a carried interest standpoint. It's a 28% to the general partner, 72% to the limited partner, up until we've got a cumulative annual return of 20%, and that's calculated on each project. For the good projects that we have that go over a 20% return, it's a 70-30 split. And if we get one that goes over 30% IRR, it's a 60-40, 60 to the LP, 40 to the general partner, and we'll probably have one of them that'll be that good. We do invest along with you. The one-time acquisition fee is $33,000. That's divided pro rata among everybody who provides capital. So myself as a general partner, I'll be putting money in. I'll be paying a pro rata share of that flat fee. The annual management fee is $66,000, and that too will be divided pro rata among everybody. And I don't anticipate that we'll have these other expenses because we probably won't get an external audit for this. It won't be required. So a couple of testimonials. Jay said that Ironton Capital helped me reduce the time and headaches I had when I managed my rentals, and we're on track to beat my old returns as well. Jared, 15 months struggling almost nonstop with his rentals, sold several of them so he can invest passively with us, and he said, it feels good to have the time back with these passive investments. Ironton made it really easy. And Justin was able to transition from working as a small business owner and a landlord to selling most of his assets, and he's moved to Portugal. His new passive income from us enabled him to be able to do what he's always dreamed of doing with his family. So I'm very proud to be part of enabling a great lifestyle for him and our other investors. So imagine and picture this. You finally get your time back, time to relax and enjoy the quality time with the people who matter the most while your portfolio continues to grow. I want this for you. So let me ask you, did we provide value for you today? Did you get some insight into what you might have been missing when you thought passive real estate investing was out of your reach? Would you like more? So here's the funds that we talked about earlier today, and this will be for Fund 11 that we discussed. So what are the things that we bring to you? Rapid results, because we do all the locating, touring, and due diligence for you. And you'll have more time to do what you want, when you want, with the people who matter. You'll be enjoying greater diversification across geography, asset class, strategy. And this investment is entirely and truly passive. We do all the heavy lifting. We provide quarterly updates, and you deposit the gains. Does that make sense? Well, if I did a good job, would it be okay if I share with you how you can go deeper into exploring this investment? Who is it not for? It's not for the people who want to do it the long, hard way, for the people who want to jump in with their eyes closed. I want you to know exactly what's included, and you want to check with your financial advisor to make sure that we're a good fit for your overall portfolio planning. Who is it for? Accredited investors who are done dealing with renters, or professionals who are tired of looking at endless deals after work, or retirees who are done managing and they just want to leave the heavy lifting to the experts. Sound great? So we have a satisfaction guarantee. Like I mentioned, when we get done picking all the investments, you'll have 10 days to decide if it's for you or not. If not, we'll give you your money back. I want you to be as excited as I am about the investment. Also, we have an early bird 10% return. So if you are in the first 45 days, that is by Friday, September 5th, and you make your deposit, you'll get a 10% return calculated from the date of your deposit until when we close the fund, which will probably be in early December of this year. And whatever that amount is, that's going to get added onto your balance. So instead of you sending in $100,000, it's going to be $103,800 or whatever the math ends up working out to be. So it'll help to amplify your returns a little further. What is an accredited investor? Well, you have to meet one of these criteria. If you're single and have a household income over $200,000, if you're a dual household income over $300,000, or if your investable assets are over $1 million, not counting your primary. If you meet any of those criteria, we are allowed to work with you. We've got just a simple one-page form for your CPA attorney to fill out to show that you're accredited. If you don't have a CPA, just do your taxes yourself. We have an alternative method for you to easily do this. How do you fund it? You can use cash. You can use your self-directed IRA. If you have questions about that, we've got specialist Stephanie that will walk you through all the steps. You might take cash out with a line of credit from one of your properties. So if you've got a rental property with a lot of equity, I can introduce you to banks that will do a second mortgage, even on an investment property, to free up capital. You do a home equity line of credit on your primary. Lots of different ways you can do it. So if you're curious if this is right for you, you might be an active investor now with a rental that's cash flowing, and you're curious, how would Ironton's investment compare to what I have currently? Well, just go to irontoncapital.com/review, set up a time, and we'll do all that math for you. We'll show you the wealth accumulation for your family over the next decade if you just hold on to that rental, and then show you the alternatives if you were to sell it and put it in the stock market, our medium-term fund, our long-term fund. What would the advantages and disadvantages be financially of those different choices? And then you and your family have all the facts you need to make a really well-rounded financial decision. So please take advantage of that. Thank you for making the time to listen to me today, and I hope to talk to you soon.